Let's get more on the latest inflation figures from Jimmy Jean, chief economist and strategist at Desjardins. Jimmy, great to see you once again. Your take here is another month, another soft inflation reading.
Absolutely. I think there's, every inflation print, there's a little bit of anxiety as to whether there's going to be some nasty surprise that will force the bank again to stay on the sideline. But that wasn't the case. Actually, inflation came in slightly below consensus here. And, you look at the internals of this report, you look at the distribution of what's happening. And, right now you're seeing that very nice compact distribution, items really hovering around the 2% mark. And really, areas where you had upward pressures in the past come in well behaved. One of the statistics that I watch very closely is the 3-month annualized pace, because it gives you the direction of travel for the future year-over-year numbers. And when we look at core goods, it's now at 0.7%. When we look at core services, it's now down to 1.7%. So those are quite a bit below 2%. So the Bank of Canada will be very satisfied with what it's seeing.
Just to get, the number, the 3-month annualized rate of core goods inflation, now less than 1%, as you say, and then the 3-month annualized rate of core services, only 1.7%. So, Tim Macklem, almost certain to cut rates tomorrow, or what would your projection be, Jimmy?
Oh, yeah, I think right now you see how markets are pricing this almost in full, similar to what you're seeing in the United States. And Tiff Macklem was pretty clear that they were looking at a number of things. For instance, how the economy was handling the counter tariffs, because this was still a report that had counter tariffs. The future reports will show that effect fading. But even in this report, we don't see much evidence that it's having that much of an impact. So that was one of the areas they were looking at. But they were also looking at the labor market. And the labor market has clearly been deteriorating in the last few months. 100,000 jobs lost in the course of 2 months, and very spreading out in services in particular. So that's something that will be top of mind, I think, whereas inflation is very well behaved. So I think it's not just a matter of whether they cut tomorrow, but whether they continue. And we do happen to think that the Bank of Canada still has 3 cuts in store.
So their core rate, 2.75%, and you think the rate will get down to 2%?
Yeah, that's correct. We think those signs that we're seeing on the economic front, there might be still some challenges ahead. We see the unemployment rate going up, not just for the youth. That was the story maybe last spring, but more and more you're seeing the unemployment rate go up for people 25 to 54, the core workers, as we call them. And those happen to be the people that have mortgages, that have car payments. So the macro implications are much more significant when you're seeing deterioration in that age cohort. So I think the Bank of Canada is going to want to be much more alert to that. And by incident, I think it means that the Bank of Canada will slowly but surely take a forward-looking approach, which is it has kind of stepped away from, given the uncertainty. There's much less uncertainty right now when it comes to tariffs, trade policy. I think things are settling in a place that might not be very favorable, but settling nonetheless. So now it's time to look forward a little bit more.
But are lower interest rates even stimulating the economy if businesses aren't investing in productive assets? I mean, sure, stocks may go up and consumers may take on more debt, but is that really boosting the economy?
Well, for sure. When you have the type of uncertainty that we've been dealing with since the beginning of the year, it has companies freezing. And it's not just a matter of tariffs. You also have what's happening on the population front and the uncertainty as to the future policy moves that will be made on that front. So that has some businesses that rely a lot on some of those foreign workers really on hold. So there's a number of items that are contributing to that state of, that status, if you will. But the Bank of Canada here, it's mandate is on inflation. And if you let things deteriorate further, you're going to quickly find yourself with the very familiar problem we had prior to the pandemic, which was too low inflation. So ultimately, that's really what it's about. And I think this is still an economy that has shown to be responsive to interest rates. So when they are lowered, we're likely to see some pickup, especially in the housing markets of Vancouver and Toronto, which have been pretty battered this year.
But haven't we been investing too much money in housing and selling and buying houses? It almost feels like it's parasitic on the truly productive sectors of the economy.
Well, for sure, we're hoping at this stage that the federal government will be able to execute. We know that the plans, what has been put forward, is very bold, ambitious, and maybe promising. But really, the devil's in the details, and really in the execution of it, and that's going to be the tough part. The infrastructure, the focus on defense, and how that could spill over to strong business investment, job creation, and also diffusion of technologies. That's really what we're going after. It's going to be a long-term play for sure. But I agree. Lower interest rates per se, over the last few years, if not decade, we've seen that they haven't been the sole response to get that productivity element fixed. It's going to need a lot of credibility on the part of the government and support from the private sector.
Jimmy, thank you very much indeed. Jimmy Jean joining us. He's chief economist and strategist at Desjardins.